Thank you, Paul. Good morning, everyone, and welcome. It is a pleasure to be here with Senior Deputy Governor Carolyn Rogers to discuss with you today's policy announcement and our monetary policy report. Today, Governing Council maintained the policy interest rate at 2.75% following 7 consecutive cuts. The Canadian economy ended 2024 in good shape. Inflation had been close to the 2% target since last summer. The substantial interest rate reductions since last spring had boosted household spending, economic growth had picked up, and many businesses were telling us the economy had renewed momentum. Since then, the dramatic protectionist shift in U.S. trade policy and the chaotic delivery have increased uncertainty, roiled financial markets, diminished global growth prospects, and increased inflation expectations. The path for U.S. trade policy remains highly unpredictable. There's also considerable uncertainty about the impacts of a trade war on our economy. At our monetary policy decisions in both January and March, Governing Council reduced the policy interest rate a further 25 basis points as threats of higher U.S. tariffs escalated. A lot has happened since our March decision 5 weeks ago, but the future is really no clearer. We still do not know what tariffs will be imposed, whether they'll be reduced or escalated, and how long all of this will last. At this meeting, we decided to hold our policy interest rate unchanged as we gain more information about both the path forward for U.S. tariffs and their impacts. Monetary policy cannot resolve trade uncertainty or offset the impacts of a trade war. What it can and must do is ensure that Canadians continue to have confidence in price stability. Our focus will be on assessing the downward pressure on inflation from a weaker economy and the upward pressure from higher costs. We will support economic growth while ensuring inflation remains well controlled. Faced with pervasive uncertainty, Governing Council will proceed carefully with particular attention to the risks. That means being less forward-looking than usual until the situation is clearer. It also means we are prepared to act decisively if incoming information points clearly in one direction. Il est passé beaucoup de choses depuis notre décision en mars, mais l'avenir n'est pas plus clair. On ne sait toujours pas quels droits de douane seront imposés, s'ils seront réduits ou augmentés, et quelle sera leur durée. En avril, on a décidé de laisser le taux directeur inchangé pendant que l'orientation des droits de douane et leurs effets se précisant. On ne peut pas, avec la politique monétaire, résoudre l'incertitude liée au commerce, ni neutraliser les répercussions d'une guerre commerciale. Mais ce qu'on peut et on doit faire, c'est préserver la confiance des Canadiennes et Canadiens dans la stabilité des prix. Notre priorité sera de mesurer les pressions sur l'inflation, celle à la baisse due à l'économie plus faible et celle à la hausse découlant des coûts plus élevés. On va soutenir la croissance économique en gardant l'inflation bien maîtrisée. Vu l'incertitude généralisée, le conseil de direction va être prudent en portant une attention particulière aux risques. Ça veut dire qu'on sera moins tourné vers l'avenir que d'habitude jusqu'à ce que la situation soit plus claire. Ça veut aussi dire qu'on est prêt à agir de manière décisive si de nouvelles informations pointant clairement dans une certaine direction. Let me now turn to what we're seeing in the Canadian economy. Incoming data are increasingly pointing to a considerable slowing in business investment and household spending. After expanding 5.6% in the fourth quarter, final domestic demand is expected to be roughly flat in the first quarter. Supported by a pull forward pull forward in exports to get ahead of tariffs. GDP growth in the first quarter is forecast to be about 1.8%. But with exports expected to decline, second quarter growth will be much weaker. In the labor market, job growth was picking up at the end of last year, but trade tensions are disrupting this recovery. Employment was flat in February, down in March, and many businesses report they are scaling back their hiring plans. Inflation in Canada has risen from 1.8% at the time of the January report to 2.3% in March, reflecting the end of the GST-HST holiday and some rebound in goods price inflation. Elevated shelter price inflation continues to ease, but goods price inflation rose more than shelter price inflation came down. The prices for imported goods have been boosted by the past depreciation of the Canadian dollar. And some businesses have also said suppliers are proactively raising prices in anticipation of future tariffs. Near-term inflation expectations have also risen because households and businesses expect tariffs will raise prices. The very near-term outlook for inflation is relatively clear. The elimination of the consumer carbon tax on April 1 will reduce CPI inflation by about 0.7 percentage points for 1 year. Lower global oil prices will also pull inflation down, so total CPI inflation is expected to be about 1.5% in April. Looking beyond the near term, what happens to the Canadian economy and inflation depends critically on U.S. trade policy, which remains highly unpredictable. Given this uncertainty, point forecasts for economic growth and inflation are really of little use for anything. So in this MPR, we instead present two illustrative scenarios that span a wide range of possible paths for U.S. trade policy. In this report, we call these scenarios 1 and 2. In scenario 1, we assume most of the new tariffs are negotiated away, but the process is unpredictable and businesses and households remain cautious. GDP growth in this scenario stalls in the second quarter, then expands only moderately. Inflation drops below the 2% target for the rest of 2025 and into 2026, both because of the end of the consumer carbon tax and a weak economy. In scenario 2, we assume a long-lasting trade war. The economic consequences are severe. Canada's GDP contracts in the second quarter, and the economy is in recession for a year. Growth gradually returns in 2026, but remains soft through 2027 as U.S. tariffs permanently reduce Canada's potential output and lower our standard of living. Inflation rises above 3% in mid-2026 as tariffs, countermeasures, and supply chain disruptions raise costs, pushing up many prices. Inflation then eases as weak demand limits ongoing inflationary pressures. To be clear, these are only two of many possible scenarios, and even these do not span all the possible outcomes. Governing Council agreed that where U.S. trade policy is relative to scenarios 1 and 2 is a moving target. The April 2nd announcement put the situation closer to scenario 2, but the partial rollback on April 9 and the new exemptions in recent days have moved trade policy back towards the middle of the two scenarios. We don't know what's coming next, and U.S. policy could well move back and forth before the situation is clearer. As we considered monetary policy, we used these two scenarios to reflect the uncertainty about U.S. trade policy. We also considered the risks related to the impacts of tariffs. These could be smaller or slower or bigger and faster than captured in the scenarios. What happens with inflation will depend importantly on what happens with tariffs. And if we find ourselves in a protracted trade war, we will see opposing pressures on inflation. A weaker economy will put downward pressure on inflation, and higher costs from tariffs will put upward pressure. Both the uncertainty about tariffs and their opposing forces make forecasting inflation especially difficult at this time. Moving forward, we will pay close attention to the risks and uncertainties to the Canadian economy and inflation. These include the extent to which higher tariffs reduce demand for Canadian exports, how much this spills over into business investment, employment, and household spending, how much and how quickly cost increases are passed on to consumer prices, and how inflation expectations evolve. So let me wrap up. Depuis janvier, la politique commerciale américaine a changé de façon radicale et l'incertitude a beaucoup augmenté. Les États-Unis ont imposé de nouveaux droits de douane à des secteurs clés du Canada et à tous leurs partenaires commerciaux. D'énormes réévaluations des prix se sont produites sur les marchés financiers canadiens et mondiaux, qui restent volatiles. Les ménages et les entreprises ici et à l'étranger se préparent à une croissance plus faible et à des prix plus élevés. La politique monétaire va permettre de garder l'inflation bien maîtrisée et soutenir la croissance économique pendant que le Canada mène cette guerre commerciale indésirée. Comme toujours, la Banque sera guidée par son cadre de politique monétaire et son engagement à maintenir la stabilité des prix au fil du temps. Since January, we've had a seismic shift in U.S. trade policy and a sharp increase in uncertainty. New tariffs are now in place on key Canadian industries and on every other U.S. trade partner. Financial markets in Canada and around the world have violently repriced and remain volatile. Households and businesses in Canada and beyond are bracing for weaker growth and higher prices. Monetary policy will ensure inflation remains well controlled and support economic growth as Canada confronts this unwanted trade war. As always, we will be guided by our monetary policy framework and our commitment to maintain price stability over time. And with that, the Senior Deputy Governor and I will be very pleased to take your questions.
Okay, thank you, Governor. We will go to questions now, and we'll start with the reporters who are here in Ottawa at the bank, after which we'll go to those who have joined us remotely. As usual, I'm going to ask you to please limit yourself to one question so that every media outlet will have a chance to ask a question. If I forget to do so, please state your name and affiliation, and for those who are new, please press the green button in front of you to activate the microphone. Shut it off again, please, when you're done. Avant de poser votre question, veuillez vous identifier et si je ne l'ai pas fait, et comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. So we'll have our first question here in Ottawa, and I'm going to start with Paul Vieira from the Wall Street Journal, please.
Governor, why wouldn't you cut today, given some of the downcast numbers that you presented in your NPR and communications, such as the 7% drop in real estate activity and the considerable slowing in business investment and household spending? Don't those conditions warrant a cut?
The short answer, Paul, is the Canadian economy is starting from a good place. There's a lot of uncertainty, and we're navigating carefully. So let me unpack that. As I highlighted in my opening remarks, the Canadian economy started the year in good shape. Inflation has been close to 2% since the start of the year. We reduced interest rates substantially. Growth picked up. Employment strengthened. As we came into this year, there have been escalating tariff threats by President Trump. We lowered our policy rate in January and in March by 25 basis points. And in March, we said we would be less forward-looking and we would be proceeding carefully with further changes in our policy rate. Look, a lot has happened in the last 5 weeks since our March policy decision, but really the situation is no clearer. I mean, tariffs have been announced, they've been imposed, they've been retracted, they've been threatened again. So at this meeting, we decided to leave our policy rate unchanged while we wait for more information on what's going to happen with U.S. tariffs, and while we assess the impacts that you alluded to of increased uncertainty and higher U.S. tariffs. Look, the message is we're navigating carefully. Our goal is to ensure that Canadians stay confident in price stability.
Our next question is from Jordan Gowling from the Financial Post. Go ahead, Jordan, please.
You talk a lot about concerns over upward pressures to inflation, downward pressures on the economy, but is there one that you're more worried about than the other at the moment? How are you balancing those two when you're making your decisions?
I mean, our target is 2% inflation. We think about that symmetrically. We're just as worried about inflation being above 2% as below 2%. Yes, we're very focused on assessing both those downward pressures on inflation from a weaker economy and the upward pressures that the tariffs and higher costs will mean for future inflation. What we did do, and you can see this in the press release, is we did break that down to try to highlight, 4 things in particular that relate to those downward pressures and those upward pressures. So, I mean, we're particularly watching the impact of higher U.S. tariffs on our exports to the United States. How much do they weaken? And then secondly, how much do weaker exports to the United States spill over into lower investment in Canada, weaker employment in Canada, weaker consumption? Those will have those are very important for how big those downward pressures are going to be on inflation. The upward pressures really come from tariffs, countermeasures, supply chain disruption. So we're going to be watching carefully how higher costs get passed through to the prices that consumers pay. And we're also, of course, going to be closely watching expectations of future inflation, both shorter term and longer term inflation expectations. And the message is, look, we're going to do as much as we can to support the economy while maintaining our primary focus on price stability.
Okay, next I'll call on Mark Rendell from the Globe and Mail, please.
Thanks, Governor, for taking the question. You say in the statement that you're prepared to act decisively as things become more clear in one direction or another. Does acting decisively mean the potential for a larger than 25 basis point cut? And does acting decisively mean the possibility of an intermeeting cut?
Look, I would not over-rotate on the word decisively. It's not a code word for anything. Really, in using the word decisively, I was really trying to convey how we're thinking about monetary policy through this period of uncertainty. So, the point is that right now, the outlook is really clouded. And so we're being less forward-looking than normal. We're navigating carefully. If the situation becomes clearer, we can become more forward-looking. We can, as we usually do, go back to having a base case economic projection, and then the focus of our monetary policy deliberations will be more about, what's the best monetary policy given that base case projection. So I use the words proceed carefully and act decisively really to convey that, we're in a period of very elevated uncertainty. If that clears, we can be more forward-looking again. And certainly, if the data is tilting clearly in one direction or the other, we can respond decisively. I mean, I think really, Mark, the message here is we got to be flexible and adaptable. And I was really trying to convey how we're thinking this through. It's not a code word.
Okay, I'll call on Greg Quinn from Market News next, please.
Good morning. The statements discuss the turmoil created by U.S. trade actions quite a bit. I'm wondering if you would agree with some investors who believe that the role of the U.S. as a trusted trading partner and its currency as a global reserve currency is coming into question. And more specifically, if I'm a corporation that doesn't send the vast majority of my products to the U.S., isn't there incentive to hive off and cling to another major economy rather than get sucked into U.S. trade demands?
You want to say a bit about the impacts in financial markets?
Yeah, I mean, we've seen a ton of volatility in the financial markets. I mean, the markets, I think, are trying to do what everybody's trying to do, is digest the steady stream of announcements coming out of the White House and figure out what it means. If you're a business, you're trying to do the same thing and make the kinds of decisions you're talking about. In terms of a reserve currency, I mean, I think it's premature to read anything sort of structural into what we're seeing or to kind of get ahead of ourselves and declare those kinds of things. I mean, we did see some unusual moves in U.S. yields, but they've settled down since then. So it's pretty premature to make those kinds of declarations. I do appreciate how consequential those kinds of decisions are for businesses. I imagine they're doing the same thing we're doing, which is hoping for some clarity.
Yeah, I'll just add, next week I'm on my way to New York and then Washington for the spring IMF meetings. I expect there's going to be a lot of discussion on these issues. So.
Okay, I'm going to go to the back corner now for Craig Lord from Canadian Press, please.
Good morning, Governors. Thank you for taking our questions. In your severe scenario, inflation rises briefly above 3% next year and comes back down, and that's not, the decades-high levels of inflations we were dealing with in the recent years. Does that, therefore, give you any more leeway to either reduce interest rates further or keep them lower, with inflation unlikely then to move too far beyond your target range?
Well, look, I'd highlight a couple things. First of all, you have to remember these two scenarios are two illustrative scenarios among many things that could happen. The other thing I want to stress is that, even if you told us, okay, this is the scenario, there's still going to be a lot of uncertainty, particularly with respect to how inflation responds. And in fact, if you go back to the speech I gave in Calgary a few weeks ago, I illustrated that. So, the response of inflation is going to depend a lot on how much and how quickly businesses pass through higher costs into inflation. So the more they pass through and the faster that happens, the higher inflation will go. It's still, of course, the faster they pass it through, it'll go higher, but it'll also come down faster, providing monetary policy does its job. So, also to say, there's uncertainty about the scenarios. There's also uncertainty about exactly what exactly the impacts will be given any different scenario. I mean, we have not had anything like scenario 2. This is an unprecedented shock in more than 100 years. To get to your question, why inflation certainly goes up. Tariffs add costs. Supply chains are disrupted. Businesses are looking for other suppliers. All that adds to costs, and that gets reflected in higher inflation. But the economy is very weak. The economy is in a year-long recession in scenario 2, and that is creating quite a bit of downward pressure on inflation. So yes, inflation goes up temporarily, but it does come down. And as I've said repeatedly, we're going to be assessing those upward and downward pressures on inflation. We'll do as much as we can to support the economy while maintaining our primary focus on price stability.
Okay, now I'll go to Promit Mukherjee from Thomson Reuters, please.
Governor, will you be open for a 50 basis point cut in June if needed?
Look, we're deliberately not giving a lot of forward guidance because the situation is very clouded. I think I've been pretty clear that in this very clouded situation, we're going to proceed carefully. There's a lot of uncertainty about tariffs. There's opposing forces on inflation. We're starting from a good place. Inflation's well controlled, close to 2%. Our interest rate is right in the middle of our neutral zone. We've got flexibility, and we're going to have to be flexible and adaptable as we move forward.
All right, next I'll call on Kevin Carmichael from The Logic, please.
Governor, you described the repricing in financial markets as violent. Should we assume then that financial stability risks have gone up considerably over the last couple of weeks?
Again, why don't you take that one?
I mean, I think the initial moves in the financial markets were pretty drastic, pretty violent. Things have settled a bit since then. We didn't, though, Kevin, see dysfunction in the market. So the market seemed to absorb what was a pretty big shift without big dislocations. I mean, there was liquidity was a bit constrained for a while. Spreads widened. We saw what you would expect to see when you see the kind of abrupt policy shift happen, and the markets tried to absorb it in a short amount of time. We are watching closely. I mean, the one thing I would say is just like the economy came into this tariff mess in a pretty good place, our financial system is entering this in a good place. Our financial institutions are well capitalized. They have some room to absorb this kind of volatility, but we'll definitely be watching for signs that the short-term volatility is starting to affect stability. We've got our financial stability report out in a little over a month, so we'll have more to say then.
Theo Argytis from The Hub.
Hi. What struck me about the scenario 2, which is the escalation scenario, is that you're still projecting a moderate recession, not a deep recession, much more moderate than 2008, 2009, for example. How should Canadians think about the probability of a deep recession? And in that scenario where we have a deep recession and a stagflationary environment where inflation remains stubborn, what would you do in that scenario?
Okay, Theo, well, as usual, you've packed a lot in. So I talked in a previous answer about there's a fair degree of uncertainty about the effects of higher tariffs on inflation. There's also a fair degree of uncertainty about the effects of particularly a scenario 2 where you get really a historically unprecedented escalating trade war. So yes, I mean, we've calibrated the response that I would call it a serious recession. It's a 4-quarter recession. It'll be painful. We've calibrated that response, over the sort of historical sensitivity of U.S. consumers to higher costs of Canadian exports. Particularly when you get a shock that's really big and outside of historical experience, there is a potential that the response could be different than what we've seen. And in particular, it could react more than in proportion. I mean, to be blunt, look, some exporters could go bankrupt. That could spill through the economy. Unemployment could rise more. Households spending could retrench more. So yes, that is a risk. There's a reason that we have 2 scenarios. I mean, that is certainly a very bad outcome. There are also scenarios where this trade war ends relatively quickly, tariffs get negotiated away, the uncertainty goes away, and we look back and say, oh, that was really unpleasant, but it wasn't a real crisis. So we'll see. I think, in terms of the policy response, this gets back to, look, if right now there's a lot of uncertainty, we're navigating carefully, we're proceeding carefully. If things break clearly in one direction, yes, we're prepared to act decisively.
The other thing, Theo, just to add to what the governor said, it's really important. You use the word projection, and we don't think of either of the scenarios as a projection or a forecast, right? When we sat down to deliberate, normally we have a projection. And because we didn't, we created these scenarios just to try to illustrate how we thought this was going to play out. But I'd want to just be careful not to use that word, right? They're illustrative scenarios.
Okay, and our last question here in the room goes to Randy Thantong-Knight from Bloomberg.
Governor, you said in your remarks that point forecasts for growth and inflation are of little use as a guide to anything given the uncertainty. Should we discount views from economists who continue to offer their point estimates of GDP and inflation? And are you worried that by removing these base case projections, it could add to Canadians' already elevated anxiety about the economy?
Well, I think giving Canadians a false sense of precision would not be doing Canadians a good service. I think everybody's feeling this uncertainty. I think everybody's watching the daily announcements coming out of the White House and seeing the erratic, unpredictable course of U.S. trade policy. If you look at forecasters, there is a broad range of forecasts out there. And if you look at private sector forecasts, what you see is the broad range of forecasts largely reflects very different assumptions about what happens with U.S. trade policy. Some people have, very negative forecasts, recession in the U.S., recession in Canada. Others have more of a temporary downturn and then a rebound. Look, I think anybody using these forecasts needs to be thinking that there are a range of possible outcomes here. Every business, every Canadian is coping with this. What we've tried to do is outline how we're managing through it.
Okay, we're going to go to the phone lines now. We'll start with some apologies as we took a little time to get everybody into the right room, but I think we're all good now. I will remind you, the folks on the line, come off mute, please, only to ask your question, then go back on mute as soon as you finish so everybody can hear the response. I'm going to start first with Rob McClister from Mortgage Logic News, and after that I'm going to go to Anis Haidari from CBC. So Rob, to you first, please.
Good morning. History has shown that recession and surging inflation are not always mutually exclusive. So given that and other things equal, how long would inflation need to stay above the 3% control range limit in a recession scenario to not be considered temporary? Are we talking months or quarters? Or
Look, Rob, what we want to ensure is that Canadians don't lose confidence in price stability. I'm not going to, we've put out a couple of illustrative scenarios, and they give you, a sense of the inflation outcomes could be pretty different. The first scenario, inflation stays pretty close to the 2% target. In the second scenario, it rises briefly above 3%. Could it rise? As I highlighted, there's uncertainty about exactly how quickly and how much higher costs get passed through. It could rise more. Our focus really is ensuring that Canadians remain confident in price stability. And why is that so important? Canadians are facing so much uncertainty already. We don't want them to have to worry about higher ongoing inflation. And our commitment is yes. If there are significant tariffs, there will be cost increases. Prices of many goods will go up. There's nothing we can do about that. What we're focused on is making sure that those first round pricing increases from the cost increases don't spread to other prices and become ongoing inflation. That's what we want to make sure Canadians are not worried about. They have enough to worry about. We don't want them worrying about ongoing inflation.
Okay, next is Anis Haidari from CBC, followed by John McFarlane of Yahoo Finance. Anis, go ahead, please.
Hi there. Thanks for taking my question. Given how much we are talking about uncertainty right now, and you've sort of introduced the idea that if things, let's say, settle down with the United States, that uncertainty might go away. This is almost a two-pronged question. Like, is there a way to get rid of this uncertainty that the Bank of Canada can assist with? And is there anything the bank can do within its powers to help business confidence, which is quite low?
Unfortunately, there is nothing the Bank of Canada can do to reduce uncertainty about U.S. trade policy. What we can do and what we are doing is what we're trying to do is assess the impact of tariffs and uncertainty on the economy. And I would highlight three ways we're doing that. First of all, as you saw in this monetary policy report, we're using our economic models with scenarios, with different tariff scenarios, to understand the channels and the rough magnitudes of how that would affect the Canadian economy. The second thing we're doing is we've upped our regional outreach and our use of surveys of households, of businesses, to better understand how they are coping with this uncertainty and with tariffs. And then the third thing we certainly will be doing, we have been doing, we will be doing, is assessing incoming data. I mean, so far, the impact of tariffs and uncertainty has largely affected what I would call prospective indicators. So these would be things like financial markets that look forward. They are things like consumer sentiment, business sentiment, and expectations of inflation. We're starting to see some impacts in the real data. You can see it. You can see it in the latest employment data. You can see it in the housing data. And I expect you're going to see more in the releases to come. So what we're really focused on is we can't reduce uncertainty about U.S. trade policy. What we can improve, though, is our understanding of how that's impacting the Canadian economy. And certainly that's what we're focused on.
Okay, John McFarlane from Yahoo Finance, followed by Anna Pereira of the Toronto Star. Go ahead, please, John.
Hi, thanks for taking our questions. There's been very little mention of the housing market this time around, but recent data has shown that it's struggling. How is the bank thinking about housing at this point?
Yeah, I mean, we have seen, particularly in the Toronto area, we've seen a pretty big drop in housing activity. I think there's a number of things going on there. There's a fair bit of supply coming on, particularly in purpose-built rentals and in condominiums. You're seeing the effects of a change in population from the immigration policy. And then, of course, you're probably seeing Toronto, Ontario is a market that's probably being hit proportionately more than others by the degree of uncertainty around U.S. trade. So all those things, I think, are adding up to a pretty big impact, particularly in the Ontario and the Toronto area on housing. It's one of the variables that we consider at every rate decision. Housing's had a sort of an outsized impact on our economy for a while. I think it's been overtaken more recently by trade policy. So that the fact that you're not hearing us talk about it as much is really just a reflection of our focus now on the same thing Canadians are focused on, which is the effects of trade policy on the economy.
Okay, Anna Pereira from the Toronto Star.
Hi, good morning. Economists and markets were predicting basically a coin toss chance that you were going to cut by 25 basis points today. And I know we'll get more information in the summary of deliberations in a couple of weeks, but if you could comment right now, how close a call was today's decision?
Well, maybe Carolyn and I will share the answer to that since we were both sitting around the table. Look, we did, as you said, you'll see this in the summary of deliberations. We did, much like we did last time, actually, really consider two options. One was hold, keep the rate unchanged where it is. The second, cut by 25 basis points. Last time when we deliberated, in the end, we decided to cut. Having cut, and with really not much further clarity on what's going to happen with U.S. tariffs, we decided to keep the rate unchanged this time and wait for more information on U.S. tariffs, while we also assess the effects of the effects that we're seeing in the economy of the uncertainty and the U.S. tariffs. So I don't know. Do you want to add to that?
Yeah, I mean, I think every decision starts with a range of views. I mean, there's 7 of us now. We have a new external deputy governor, Michelle, who's joined us. And so we all come into it and into every decision with a range of views. I would say this time around, to use the frame that the governor set up, well, the sort of 2 layers of uncertainty. The first is what is actually going to settle out to be the U.S. trade policy. I think in that case, we're all doing what every Canadian's doing right now, is just kind of glued to the news and digesting the steady stream of announcements that come in. So that one's really hard to have any conviction on. And then once you sort of can think past that level of uncertainty, then you get into, once we know what the policy is, how's that all going to work its way through the economy? And there, I think that's where you sort of have different perspectives among the governing council members. Some of us are, I would say, more optimistic that the effects won't be really, really big, and we won't see that, a really big upward pressure on inflation. And then there's the effects on growth. So, I mean, I think that's where a lot of the discussion centered this time. It's really hard to have a lot of conviction on either of those 2 layers of risk right now, but after some really good deliberation and taking in everybody's views, I mean, there was a real clear consensus on a hold being the right decision at this decision.
Okay, we just have time to check. I know we had some connection issues. Max Sato from Mace News, are you there? And if so, would you like a question?
Thank you, Mr. Battershaw. Yes, I am. Can I go ahead?
Please go ahead.
Good morning, sir, ma'am. If I may ask both of you, if you look at other countries' G7 average, and in the case of Japan, Governor Ueda must be envying you and the team. Look at the inflation rate, like 3%, and I think G7 average rate recently 2.7, and so. Do you think, compared to those situations, Canada's faring much better? Because not just Canada, Japan is also being hit by tariffs. So how do you assess the whole situation?
Well, as you suggested, there is a big global impact to this. I mean, virtually every trading partner the United States has is facing new tariffs. I think for Canada, unlike most other countries, the U.S. has not imposed universal tariffs. Well, actually, they imposed them twice, but they've retracted them twice. Right now, there are no universal tariffs. But we do have tariffs on some very important parts of our economy: steel, aluminum, the auto industry, and elements that are not compliant with the USMCA. And, for Canada, the other element, well, first of all, I mean, for Canada, our economy is so integrated with the United States. The impacts are particularly strong. The other element that's important for Canada in particular, because our economy is so linked to the United States, is actually what happens to the U.S. economy. And, you know, these U.S. tariffs, they're not good for the U.S. economy either. In fact, in scenario 2, the U.S. economy goes into a recession. If the U.S. economy goes into recession, that's going to further weaken demand for Canadian goods and services. So, you know, I think for Canada, look, this is a huge deal for every country. For countries like Canada that are closely integrated with the United States, it is a particularly big deal.
Okay, and that will conclude today's press conference. Thank you, Governor. Thank you, Senior Deputy Governor. And thanks, everybody, for joining us today. See you next time.